Come closer, lovers of boom and crash, and at the same time, pains and gains on well trade. I know some of you trade boom and crash, but the way you have been trading it, I told you, Felix, price actions and support resistance liquidity concept is what you need. I'm going to simplify how you should be trading your boom and crash. You're not trading for long term, you're just catching. Some can trade against the spike, but I don't like it. So that's why. Now, I'll recommend for the people who trade on deriv, maybe boom 1000 and crash 1000. If you want to add 500, well, that'll become your choice. But let me just experiment to you how you should work on it. So take a note, jot down this thing. Jot down this thing now. You're going to jot down this thing. Right? So you can screenshot it and jot it down. What you need. This Plan B Express. That's Felix P&L trading strategy. Basic. Trading boom and crash or pains and gains. Require price actions and liquidity component needed. Market structure, AOF. Fibonacci retracement, market structure shift, or change of character. So maybe what to put it. So let's put it that way. Slash COHCH. Break of structure, order block, swing point, then 4 hour, 1 hour, 30 minute, 15 minute, 5 minute, 3 minute, 1 minute time frame. So copy this, screenshot it, and let's work. I'm going to be very brief. So let's go. And what are the steps? You're trading boom and crash, not other instrument. It still work for other instruments, but I want to be particular about boom and crash. So let's take boom 1000. So first of all, I'm going to go to 4 hours. And then let's take boom 1000. So let's select boom 1000. I'll see. Now, this is the thing. Once the boom 1000 is not trending, I may not take it. Did you understand? So first, what you want to do is to identify, is it trending? Is it an uptrend or a downtrend? So if it's an uptrend, fine, I'll work with it. If it's a downtrend, I will not work with it. Do you get it? All right. Like this now, it will be confusing for you because even if you take your trend line, you can see practically speaking that boom 1000 was an uptrend. Now it's a downtrend. So it's a bit complicated for you. So you don't need to overstress yourself because if the market is not pure, it's not pure. Okay. So I would go to crash 1000. So it's the same thing you're going to be doing. Okay. But you may want to ask me, okay, assuming when it was bullish, what am I going to do? Very simple. Work with the structure. Work with the structure. So why do I come to 4 hours? Ordinarily, you should be using 1 hour. That will give you result on time. But I'm just going to show you 4 hours. So now identify structure. The first thing you would need to do is to identify the structure, which you already see is an uptrend. So when the market, of course, went whatever it was coming from, on 4 hour time frame, so for reference sake, this was the last structural break to the downside. And then this was the swing high. Okay. Now it broke to the down. So this one become a low. Now you expect the market to take out this to confirm an uptrend entirely in that 4 hours. But before then, market structure has changed. And how does it change? So you now, when the market came down to this point, you actually want to find a trend. So here, what to find here was this. We already have a new high. Okay, very simple. Okay, so this is a new high. So when the market get to the last point and moving up, So what you expect, we call something point of origin. What you expect was that let the market come to this point. So this point I mark is what we call order block. So order block means the opposing candle against the movement. The opposing candle, the last opposing candle against the direction. Sometimes even the whole entire order block can form all of this together. Are you following now? So now, so if that is the case, so what you actually expect was that the market should travel all up to this point and reject so that I can sell down and further break this structure. So that means the market will continue to go down. But in this case, market did not get there. So market now got there and start retracing. Now, this is the first step you are going to need your Fibonacci retracement for. Okay, so now what do? I'm going to take my Fibonacci retracement from the low to that high. So from that low to that high, let me quickly open my Fibonacci retracement setting so that you can do the same thing with yours. Now, I changed this one, this 0.236, I change it to minus. And then I take over all of those numbers, I reject them. So all I need is 0.5, 0.78. Okay, I put this one there for myself, and I will tell you what it's used for. I put 1.25, then 1, okay, I put minus 0.5. Other remain, I take out this, that's 0.3842. So you can snap it. Now, what this means for me is that you see this first negative is my first take profit when I find an entry, and the second one is my second take profit when I find the proper entry. Now, so what happened? The moment you scoop out this, you are going to mark from that 5 to that 78 as an area of focus. So since I've marked it as an area of focus, I've taken it out. So I've marked it as an area of focus because when market came here, I was pushing up. I didn't do anything. The market was now trailing down. I marked this as an area of focus. Now, since an area of focus, okay, since an area of focus, the next thing you want to do is to go to your lower time frame. I'm using 1 hour, 4 hours first, and I'll go to 1 hour. Now, when I want to go, the first lower time frame I will go to, if I'm on 4 hours, is straight to 15 minutes. Okay, so straight to 15 minutes, and I will tell you. So you can see those content, those elements or components that say they are needed. Okay, so let's go here. Now, when the market come down to that point, okay? So, okay, yes. So, there's other thing you would need is called FEG. So I forgot that. It's called FEG. Now, when the market came here, so ordinarily, if you go back to that 1 hour first, 4 hours, you will want to see some point too. See, this one was premature because this is a powerful one. Why is it a powerful one? So inside this place, there is an FEG. Okay, see? So I probably want to mark it with another color. So just understand what I'm trying to establish. Now, FEG means fair value gap. That is 3 formation of candle. The first candle, open and close with its wicks. Okay, I need to be very fast in doing this because this is not a full teaching. It's just for you to follow a strategy. So FEG means the first candle closed and the second one opened. Let's say like this. Okay. As the second one opened and closed, you see this is bearish, right? So when this one closes here, the new candle opens because this is where it closes. So perhaps it open, first travel up a bit, okay? First travel up a bit and later, return down, okay? So what has happened is that the market is not the price is not balanced because it left a gap. Can you see? So the gap between candle 1 and candle 3 is called effigy. Okay? So that means it's 3 candles that actually form. So towards the direction of where the market, that means it's a market already moved away. So that it is expected for the market to return back and balance the book that was not fully balanced or closed. So it could tap into it or mitigate 50% of it. So where you have FEG does not mean that certainly market must come there that time, because it can be inverse and create another opposite one. So let's go. I don't want this to be too lengthful for you. So all you do is, what should I look out for? So I've seen now. So you have marked all of this. So when we come back to 15 minutes, so when 15 minutes is not giving you what you are looking for, you are permitted to go to 5 minutes. Here we come now. So the market, why it was here, it spiked. No, it's not your market. Are you seeing the lengthening? It spike is not your market. The market again continue, right? It spike. It's not your market. Now, most time, I always love to see the market, because if you look at it here, yes, this is a sweep of liquidity. Then we have another liquidity here. So this liquidity, this was not swept, but this was swept. Okay? So if I travel to 5 minutes, that can give me more refined entry. Okay, so that's why you see the timing I put in there that can work for you. You are going to find beautiful setup with rest of mind and with low risk for your entry. So pay attention and learn. So network. So pay attention and learn. It's coming up, coming up. Wasting our time. It's wasting time. We did really waste our time. So I was trying to, so going down to the lower time frame, 15 minutes, 5 minutes, and all of that. So what you're looking for is what we call change of character. Now, most time, when I come back there, so you're going to repeat what you did. So let's go to 5 minutes. It's going to show up for us now. It's because it's a bit far. Obviously, it doesn't want to show up for us. So let's just use the 10 minutes. You can still get what you are looking for in 10 minutes. So the most important aspect now is this, very simple. Now it is said to be that, okay, so money, so we have seen that liquidity have been taken. Look at it. Now, this is the high that took out this liquidity. Look at it here. This high was what broke this one. This high actually broke this one. So what you want to do is, okay, if this is the high that broke this one, the market is supposed to take out this high before you find an entry. But another thing you are going to look for, so look at it. But the market refused. So what am I going to do? Very simple. You let the market create another structure entirely. So let's look at it now. Can you see? Now, this is another structure entirely. This is another structure entirely. So I haven't taken out this. This is a breakup structure. Watch me. So what are you looking for? Now, this is a breakup structure. Then the market did this. It will come to this up here, which is a new high. This is a new high. So this new high is what you now refer to as another area that you want to take advantage of. So sometime you're going to repeat the same thing you did in another place. It's mostly you take out this, your Fibonacci retracement from this low to this high before the market. Okay? Can you see what we're doing now? So what we wanted is that when you scoop to this point, you want the market to return back to any of this region. Now, if we check this region, what is here is very simple. Can you see something? Now, if you mark your Fibonacci retracement, please take note. Remember I said master 50, 61, and 78. So I could put in percentage. 50, 61, 78. These are the places that matters to you. Now, so let's take out this. Fine. Now, inside that play, the market hasn't come down to this point. You only saw that it was now leaping down. So there's another block here. Remember, I said last opposing candle before a move. This other block is the same as demand zone because, as it were, there are times they form to become a demand zone, all right, or supply zone together. Then sometimes they interchange their function. So, but I'm not going into detail of that. Just mark where you mark your Fibonacci retracement 50, anything below 50. Check if there are other block or fair value gap in that area. So you see one here, you see another one here, and then you see the last one here. So all of this point to this point is another block for the market to go up. Now, this is one thing that's going to shock you. I do this sometime, it play out. So, meaning that once the market return by 50% retracement and come to discount level, and this is another block, you can see it tap into that other block. So this spike may be what should be my entry. Remember why is it that my entry? Is because it has come to the other block. I'm waiting for a reaction. This is an engulfing candle, empowering this. So this is my entry. Now, to be conservative, I'll put my stop loss below this swing low. But some sniper entry traders don't care. They take their below the other block itself. Do you get it now? And then that is 36. If you're using one standard, that's $36. If you're using 0.2, you know how much that's doing. Now, 1:2 risk reward should be your first target first. So 1:2 risk reward should be your first target. Or most time you target the high. You look at your left and look at the high. Now, this is where you should learn one lesson. Now, having entered this market is moving. Remember that when it now broke this structure, fantastic. Let me show you something very important. This is a breakup structure. Now, this is the normal time that you are now supposed to enter the market. Look at it. I only enter this market and sometimes market may not return. I've taken an entry. Now, secondly, here, look at what happened. Look at what happened here. Here, this market created a low and move up here. So this is, let me label them. Please, I want you to learn this, very important. This is LL. Okay? I'm taking you to fundamental. This is LL. Ordinarily, this is supposed to be LH, lower high, lower to this. This is supposed to be LL, lower low, lower to this. Now, this is LH. Let's put it that way. So if you understand market structure perfect, then you'll be fine. And patient will be what you need. LH. Why is the LH? Lower high, lower than this. So this is LL. So this is the one that bond this one. Now we have this low. So this is the high that burned this one. Now, but in that movement, the market got here and pushed up to this point. It didn't take out this. You ought to take out this before you confirm a total reversal. But in this case, the market have now pushed up and create a new high. Now, having created a new high, if you're waiting here for the market to change, maybe when you put your Fibonacci here, you push up, you adjust it. Now, so this is a new high. So that means what you have now here is just like a high, okay? But to this is the LH, okay? LH. Do you understand what I'm saying now? So meaning that a break of structure, a higher, so this is higher, lower, high, because lower than the previous one, another lower high, another lower high. So it has created another LH. Then what we want again is to create another LL. In this case, it's a no, I'm not creating an LL. What it has come to create here is called HL, higher low. Okay, no longer LL. Because when you are having a downtrend, if the market is maintaining a downtrend, okay, so what we are going to be having is presence of lower high and lower low. So understand this permutation. Downtrend, downtrend is lower high and lower low. While uptrend is higher high and higher low. I hope you're learning. Very important. Now, if that's the case, so you have this now. This is, so we have a lower high compared to this. Now we have another low but higher than this. It's now making sense. So the moment the market break out above this, immediately that's what we call change of character. So let's take it. That's what we call what? Change of character. CHOCH or MSS, market structure shift. This is now you are set to actually take trade. Remember here, remember here is already a place you place a Fibonacci retracement as your discount. You have found a discount here. Now you have another block below this point. So now, since that this market had done all this magic, this is a break, this is a high, right? Now, all of this is not a break. So don't mistake it to be a break. This is not a break. Are you seeing it now? So since this market, what you are patiently waiting for, remember you have a position open. Don't react to all of this. What you are waiting for is that the market needs to come down to this point. And then look at it. Did it come or not? It came into this other block. Now let me now show you what happened here. When it came down to this other block, see what happened here. So this candle and this bullish candle and these three candles here, 1, 2, 3, is called, it's what we call swing point. That is the most perfect entry for you. Number one, other block, right? Below the 50, that is inside a discount. And then we have another block there. This is swing point. Immediately this happen, this is your entry. Sometimes some people set a pending order. Sometimes I don't like pending order. So now, but people set pending order now. Let's look at it. What confidence would they have used to set their pending order? So that means they probably look at the order block on top of the order block. And I remember I told you, I say they will now put their stop loss below the order block. This long, so let's just say below the Fibonacci, so below the order block. So they will target first here. This is 102 point. Now, taking 19 to $20, that's 1:5 plus. Now, so you remember other point you may be checking at the other external point. Look at this external point here. And then other reference point. You know, we mark a place. So let's return back to 1 hour, 4 hours, because that's the external structure now. Okay, so you can see, you know, remember here, if you go back to the 4 hours, so remember here, you are still working as though, so you can see that. So here, you are still working as though, this is 4 hours, you are still working as though this other block will be mitigated. So that means if you are working based on that other block, you may be targeting here. Let's see, that is 1:11, 222 points compared to 20 points. So if you use one standard, that is $220 something, right? If you use two, maybe you enter 2 or 3 positions, you see what's happened. And you know this spike as fast as possible. That will be $400. Are you getting it now? This is how you refine the market. Now, let me quickly tell you something. When the market, remember, this is a swing low and a swing high. So the market now traveled back here and rejected here as though we're now going back. No, you're not going back. This is you turning to a breaker block. Now, this is what happened. Remember, this is a swing low. So where you are now going to be working on now, look at it. When the market was here, what should I do? Is it not a confusion? No, it's not. Okay, so what you're going to do is very simple. Look at it. So that means there's a break, a new break of structure from here to this high. So where is the swing low that bring about that break of structure? Is this one. So you now take your Fibonacci retracement from that point to that high. Now, as long as is anything below your 50%, it's your discount. Remember, you are buying. So you're going to mark it out. Can you see now? Now, having marked it out, you can take it away. So what you're going to do is that inside this place that you have marked out, what do we have? There is a fair value gap, a very massive fair value gap seated there. So let's mark the fair value gap out too. I'm going to mark it inside there. Look at it. Get the fair value gap. So let's change the color to black. So when you are not finding market properly, that's when you are using 1 hour. 4 hours, good, but at least you know the type of market you trade. Okay, so now let's go. So you have marked all of this, and do you jump at this? No, you wait. So you are now going to go back again to 15 minutes, or whatever. Now let's go down. Okay, I'm sorry, there's one I didn't mark. Is the order block. And this is a very powerful one. Why? There's another block, there is a fair value gap. When you have another block and fair value gap aligned together, it makes a whole lot of sense. So can you see this is another block, a bullish order block, a fair value gap, and inside discount. Very powerful. Now we're going to go back to 15 minutes. You can navigate to 5 minutes so that to find a sniper entry. But this has gone for a very long time. And so So it is when you travel back to 5 minutes, you'll be able to do this arithmetic here. So because this one now is so big, that I can't go to 5 minutes. If not, by the time I go to 5 minutes, you're going to see that this one now is a break of structure, and this is the what brought about that. Then this is a change of character. Then return back to that. I wish they can allow us to go to 5 minutes, because it's a long time. So I'm giving you this. Now, one of the secret I found in this trade is that crash 1000 give you room for more sniper entry, because we're going to do that, okay? Pay attention. Very, very important. If you can be patient enough, look at it. If it's 5 minutes, and yet we still have fair value gap here again. So if it's 5 minutes, when the market travel inside it, how will I know that I'm supposed to now enter? So look at it. This is a break of structure. Now, this man was the one that brought about the break. So if it's 5 minutes, you're going to see this thing properly. Then this is what brought about the break. So if this what bring about the break, so what you're expecting is that after the change of character, you want the market to come down. Now, if I take my Fibonacci again, I'll measure this, you are going to find the same thing. Okay, so let me expand it. I hope somebody's learning. I'm sure somebody's learning. All right, so let's go this way. Okay, see now? So now what do we do? So we have seen this. So we take Fibonacci retracement from the low to this high. Good, beautiful. So why is it beautiful? Because we have a discount level. Now, why is it beautiful again? Because there is an order block that is below the discount. Why is it beautiful? Because we have a fair value gap. Wow. These are powerful setup. Now, to an extent, some people with this, they can put a limit order, like 3 limit order. Normally when I put limit order, I do this way. Look at it. I do this way. They will put one order in the 50, another one in the 60, another one in the 78. Okay, so if they put that order, let's look at how mad and big it may be. It's just that we can't go to that what is it called? 5 minutes, if not, you will have seen. This is still around 20, and it's not big. So if you are trading with 500, you are trading boom and crash, it won't waste time for you to double the money. Look at it. Now, you target this up. This is swing high. Look at it. Massive. 140. That's about 1:6 risk reward. That is the one you pick here. Now, let's take it with something. When the market come down to this point, there's something massive that happened. Look at it, a pin bar, all right, or money star, whatever, this candle. At the close of this candle is your entry. Now, so imagine your entry at this point. But remember, it's not the time you find market. So that's why you need at least one or two instruments. This is like 12 point. And then you can comfortably use one standard. That would have been within how many minutes? $163. Now, if you are going to have more than one position and then you are trailing the other ones, this is how we reduce drastically to the barest minimum your stop loss. All right? You may not find trade all the time. You may not. So understand this. If you can be patient, you are going to be happy with yourself. Look at it as if there is no now. So remember, this was the swing high. The market now took out. So look at another high, look at another high. So imagine you are still holding a position up to this 500. Don't let people hear that you use $20 to be $500. That's big. So let's go to 4 hours. Now, this thing I'm giving to, I want it to be very as simple as possible. Now, there's something lovely that has happened here. Let me tell you something lovely that has happened here. something lovely that has happened is that, was a break of structure. There's another break of structure here. Let's quickly take it. Now, this break of structure is still not up to this external high. It's still not up to this external high. Can you see now? It's still not up to this external high. So, but this is what happened. The market is here. All right. Now, you are going to do the same thing. But at a point now, and that's why we talk about an overlap. There's an overlap. So what's the overlap here? So remember, this one was supposed to be another block, a bearish order block before. Because this is the place where many people miss it. So this is another block. Okay? Now, so let's do something. We take our Fibonacci as usual, and then from here to this high. Now, this is lovely. I love this. You know why I love this? Good. You may sometimes be looking for this, your other block here. So let's quickly mark. Oh my goodness. The whole thing just aligned. Let's go. We have to mark this to this our 78% level. Are you seeing it now? So let's take it off. Now, what has happened? What has happened is this. This was another block that was supposed to be mitigated. Now, this broke it, it became a breaker block. Now, you are waiting to say, okay, the market probably should come to this. This is another block. But there is another other block here, the closest one. So that's where you check. There's a closest one here. But if you look at it, even the closest one, the market did not get to it. Which one did he use? He used this. Now, but the most important thing is that the market is at the discount level. So irrespective of where you take trade here, you are good. So let's go to 15 minutes. You see, sometimes this one can confuse you. It got very choppy, but I'm going to deal with it. But one of the things that can even give you confidence, there's some persons, they don't even refine what I refine. They just, once they come to their area of focus, they shoot the arrow. All right, let's go. Now, if we check this now, very simple. Let's do this now. So here, we have this high, and then we have this low. So let's measure it. Because it is when the market come there, you step down to this lower time frame. Now, we have a low. So that means this is another block. Let's take this. Are you following now? This is another block. There's no problem. Now, what happened is this. We got something very unique that happened. This is another block, break of structure. This is the high, all of this here, that brought about that break of structure or liquidity sweep. So that means it is when the market did this that you have a change of character. But let me show you something. The markets will bamboozle us sometime. Market got up to this point and it came down. I don't think it get to this low and they went up. So this is already another internal change of character. Are you following? These are internal change of character. So if you take your Fibonacci retracement, right? Even here, look at it here, from this swing low to this swing high. Remember how we do that? Now, from this swing low to this swing high. So what you expect was that the market should come. So now, as the market came below, it came to that 75, 78, and mitigated this other block. I and you will have entered here and put our stop loss somewhere, because your entry will be here. It's just that we can go to 5 minutes at this point. If not, I'll show you something. Now, look at it. Your entry will have been here, and your stop loss will have been below this. Okay? So that's about how many points? 34 points. No problem. Now, you're targeting TP1 in that order. Look at what the market was doing. It was doing all of the don't shake, don't move. Let it run. Let your market run. Now, market move again. So let's take up this. So market move up again. That means as you have taken this Fibonacci retracement inside this other block, there's now a break of change of character. Returning back to this another block. You have entered. The market move came down to the same other block. This become a demand zone. That's a strong support. It came down again. It now broke this high. It didn't get to it. You are happy. The market move came down again. Can you see something? Then it still respected this one. Move again. Came back to it. Hey, what's going on? It went up again. What? There you see now. Now, the market eventually, after all of this panorama, it still came down to it again. Demand zone. Remember, your position is in and your stop loss is below here. It was doing all of this. And at the end of the day, the market now moved. Now, this movement now has broke a new structure because this was the highest. Now, if it has broken a new structure, probably you want to take another entry. You take your Fibonacci retracement again, mark from this swing low to this swing high. Now, anything below the 50 is a good entry. But what do I tell you? You have to check. You have to check some confluences in that point. Number one, look at your other block. This is your other block. Number two, we have fair value gap there. Look at fair value gap. So if you mark it and the market came to that fair value gap, look at this, then this is an engulfing candle. So you, market hadn't come to this point, you take an entry, or probably you're waiting for a massive candle. Probably you take an entry here. You push down, it's not your business, and then the market continue to move. Are you following? Now, as market continue to move, look at it. This is another break of structure. But you will enjoy this type of trade if you stay on that instrument for that period. Don't move around. Don't start looking for another move and all of that. Now, let's take another Fibonacci retracement. Take from here. Now, you first push here. The market move up again. You push again. Now, let's go. Now, it couldn't get here. Now, what really happened here? I think you tap into it. You probably will not find any trade here. I tell you, because you are waiting and the market did not come down. Finally, see the market move, 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 move again. So this is a swing point, and then market broke a new structure. Then you find another trade here. Let's take this. This is internal structure. Okay, see now, it's very possible because now look at what happened here. If you look at it here to this point here, this is another block, okay? Now, this is another block. Now, this is a fair value gap. So very, very possible that because this is a fair value gap, very large. Very large. So it's very possible that because of this fair value gap, and it's already below 50, you have entered here. It's not a problem. You have some position that are still running. Do you understand? You have closed some, you are taking some, and then the market moved. It came back again and actually mitigated. This is another block, this is another block. Look at it. It finally came back to this one. The most important aspect is that you are still within a range. And finally, this is a swing point. One, one, two, three. Power of three. The accumulation, the manipulation, the distribution. Move up again, and then the market continue to move. So, ladies and gentlemen, this is the simplest formula for you to be profitable, trading boom and crash as simple as possible. Though you are going to be waiting, you are going to exercise those patience. Now, the same thing I just did on 4 hours. You can do it on 1 hour. I just did it on 4 hours on purpose and all of that. So, but you can repeat it on 1 hour. Do you get it now? All right. So let me quickly do, because the training is getting longer. Let me quickly do crash. Okay, let's quickly do crash. Let's quickly do crash. Crash 1,000. 1,000. So in your derive, just take these two. Don't jump around too many of these instruments. All right, now this is crash 1,000. Who actually want to take a trade, and it has happened, no problem. So now this is crash 1,000. It look very ugly. What is this? It's a downtrend, so don't get perturbed. The only challenge is that you may not find trade all the time. You get it now? So if you look at it now, this is crash 1,000. It's a downtrend. Now, because why? Look at it from up here. Do you get it now? So now let's go this way. If you just check the recent structural break. So I've taken a recent structural break now, for instance. Can you see now? So this is structural break. So that means what I want to do is to take from the swing high to the swing low. Okay? To take from swing high to the swing low. So if that is the case, this is swing high to swing low. So what you are waiting for is the market to come inside your premium. That is above. You know, the other one was below 50. Now this is above 50. Now, so let's go. Now, what am I going to do? Now, when it didn't come inside properly, this one is not your entry, it's not your business. Right? The market come. Now, on even 4 hours, it formed a double top, but that's not the issue. Let's quickly look at it. Now, if we check this, so let's mark out some important area. So we have series of order blocks. So this is another block. This is another order block. We have another one on top here. So that's all of them in that order. So let's just work out. So you just have to mark out all of this. Good. So now, if I've marked out all of this, I take my Fibonacci off. Sometimes I won't take out this. I won't take out the whole stuff on its own, because I've marked the one that is above. So this one just add the teeth, so I don't need it. So I've taken out this. Now, another thing you will spot, this is a fair value gap. No, I need the one that is somewhere up here. So look at this one up here. Now let's go to 15 minutes. I think this one we can go to as low as 5 minutes. Okay, good. So all of this that was happening here, this is like liquidity. Okay, you can be more confused when you have multiple, because ordinarily if you come by this 15 minute, you will have almost find an entry, because this is like exchange of character, the return back to the other block. You will have short here, and the market again maybe took you out. But you remember, you have so many other blocks up. So if you look at this one, so let's work with this now. And then you take your Fibonacci retracement from the swing low, the swing high to the swing low. You are waiting for the market to come here. Market came here and validated the whole thing. That means no entry. That's why you are doing the second this. So sometimes if I go to 5 minutes, I can't go to 5 minutes because it's too long, right? So now you can come back to this point now. So the market has created a break of structure, so change of character. So this is a low. So sometimes, so what do? You say you're looking for the market. Remember what we did? We measure like this. So perhaps you may want to go to 5 minutes, because I think we are closer here. So, but by and large, if you look at it externally, this is structural break, and this is the low. Okay, so that means when this happens, what you are going to be measuring is here, from this high to this low. That's why I go to 15 minutes, because you're already in money before these long stories. Can you see something? Now, so we have another other block here. Let's measure it. You must train yourself to be patient. Can you see that other block? There's a fair value gap. And you can see the way the market run back to it before it sold down very well. Now, if you go to 5 minutes, I hope we can navigate to 5 minutes. But sometimes too, 5 minutes can complicate issues for you. But the only thing is that it allows you to take so many trades faster. See what 5 minutes will have done here. So this is a high, this is a low. But fantastically, what happened? We have other one that you can easily pick up here. So this is a break of structure. This is a break of structure. All of these are break. So this is a break. You can see this is a break. And this is the low that gave birth to that break. So it has market structure shift. You take this. You see what I'm doing? So you can see now, 5 minutes allow you to refine the market very well. So what happened here? There's another block. There's another other block here, but there is a fair value gap. So, but look at it. The most important aspect is that this fair value gap, remember I said I take like 3 positions at 50, at 60, at this. So that means if we take at 50, so stop loss above here. See, this is just 8. Can you see? 7, 8, something. So most time why I put this one is that I always put stop loss here. That's 10. So they're like $10. So $10. So if I'm using one ratio, so $10 to 30 something dollars, right? So if you have more trailing market, do you observe something? Do you observe something very importantly? What happened is this. The market so travel to this low. So most time when you are taking trade that way, you have to look at this low, this low. These are liquidity, right? And then the market came down there. So how many points is this? 111 points from just 7 points. Now, even when the market was traveling here, and you see I have some position open, it has not touched anything. It still only came down, came back to that region, and that's the lovely aspect of it. Now, but one thing I will always have to warn is that if you are going to face a particular instrument per time, face it. So if you cannot find on Boom, you can find on Crash, and that will have formed a nice one for you. Now, if you're working on 1 hour, it's the same strategy. Yeah, if you're working on 1 hour, it's the same strategy. So let's look at it. This is market now here. Now, so we have a breakout structure here. Do you see that? So here is a breakout structure. This is the low that gave birth to it. So if you make your Fibonacci retracement, you expect the market to travel back to this other block or the main other block, travel back there, you find your entry. So this is a breakout structure. So what will happen here is this is supposed to be the external structure. Then we'll have the market, a break of structure. So here, if you take from this swing high to see the low here, let's take the Fibonacci retracement from here to this point. You see something? It's above your 50. So this is your area. You just want to ensure that the market come back to you. This can premium. So this is a fair value gap. Okay, so there's another block here. So the fair value gap. So when you go back to 5 minutes this time around, you're going to find your entry. So what do I do here? So very simple. Allow the market to come to your region that you mark. And remember, this is a fair value gap. Here, I have so many fair value gap. Also, let's take this one too. And then we can still take the one on top. So, okay, yeah, okay, that's the major one, fair value gap. So let's take out the fib. So let's travel to 5 minutes. Right, so when you get back to 5 minutes, now one of the lovely things that makes sense here now, what I'm saying, you see all of this, markets, these are liquidity. It created another liquidity here. These are liquidity. So even if you now want to measure all of this, remember, I love the market to come into it properly. So here the market is creating, this is equal high, 1, 2. So you expect the market to come and sweep the equal high. So if we mark this now, let's go. This is a high, this is a low. So let's take our fib retracement. You understand? Even this is a break. So let's take a fib from here to this, right? So you expect the market to this from here to here, market come back here. So you already entered, okay? And your stop loss above here. So the market broke structure. You turn back again. Probably you find an entry. You came back again, full. That's full auction. So if I take my sell point, so you first of all have entered this another block. Okay. You first of all have entered here and your stop loss. So I use this. So, but if you want to use just above this, but I use this. That's 7 or 8. So first take profit here, 32. Okay. So if you want to still minimize it, I'm saying 32 because it's I'm choosing just like $1. If you're using 0 point, I don't know what's the minimum of crash 1000. I think it's 0.2. So if you're using 0.2, 0.2 multiplied by 8. That's $1.6. So 32 times 0.2. That's $6. Okay. So then you have 3 positions you have entered. Then, depending on what's your account size, very important. So let's return back to the 1 hour. So Crash 1000 give you more ways to minimize and reduce your stop loss. So you'll be targeting here. That is 123 point. So if you use like 2, 3 position, that's going to be a massive one. So let's go on again. That's in 1 hour. So we'll have a break of structure here. I think I'm on 1 hour, yes. So this is a structural break. So let's take our fib retracement from here to the lowest. I think we're in order. I think the market won't even change direction. So, but nevertheless, so this is another block. Aligning here. So see how fair value gap up here and all of that. So now, but your major point here to here. So if you go back to 5 minutes, so liquidity. So if you come here and you measure, you probably wouldn't find an entry. Let's look at it. See here now. Take Fibonacci retracement from here to here. It didn't come, it didn't wait. So let's take it on this low, because you can see this is a break and this is a low. So you see, are you saying something? Remember? So what you're looking for. So as we measure from here, we want the market to come to this point to mitigate whatever markets didn't come, just like tapping and close again. So returning back here, that was not powerful. Yeah. So that's why you need to do the second move. So now let's take this. This breakup structure. This is a low. Okay. So if it's a low, let's measure it. So let's take it. Fibonacci. Okay. Market come. Actually, you probably will lose a trade here. Very possible. You've taken it, it comes so choppy and not fascinating. You probably will lose a trade. The momentum is weakening. That's what I can observe. So your impatient will have let you leave the market. So this is a breakout structure, this is a low. Now, if you're going to work with this, so if you take this now, so that means you're taking a fib level here to this before the market travel back to it. But this is extreme and not too powerful at all. Okay, so I was actually targeting to enter a market here again. So that is the way. So this market is about to reverse, it's getting to an exhaustion point. That was what I can observe. So please pay attention. It's very, very important. Pay attention. This work like magic. So it's the same thing that happens to, so any of the pain and gain you probably want to use. Like me, I just love to be on particular. So look at this gain, 400. So let's go on 4 hours, 1 hour. So why not daily? It may take longer time for you to find a trade. Okay, so let's go this way. I have a breakout structure here. Let's see this high. This is a rejection. Market getting to exhaustion. So, but now look at it. It's a breakout structure. It's the same thing. So you take your fib. Is the thing I hate in well trade. They have not organized this, their tools. So I take out this minus, and I remove all of this and check, this one minus 0.5, minus 0.5, 0.5. Remove the background. Put in percentage. Right. So see what has happened here. All right. So here we go. Remember your point of interest, your area of focus. Beg your pardon. So we have another block down here. Probably have another one here, or a fair value gap. Have you seen something? So all of them are below so this is another fair value gap. So we can pick that too, just to align everything you're doing. All right, so let's take out this gentleman. So let's go to 15 minutes. It's the same principle everywhere. Remember what you're looking for. Just that this, this world trade is not as structured as the synthetics. Okay, so by default now, market has come to this point. So you will have find a trade here, and you can see that the market kept dialing there. So look at the structure. This is a high, then this is sweep of liquidity, then it created an internal high. So here I found a shift in market structure. So ordinarily, you did your fib level. So it's a shift that will have given you your entry here. Because if you take our fib from here to here, everything still travel back to like double bottom. So, but this is the most important thing. We have another block, another one here. So the two alignment. So we have a shift in market structure. So this is part of 3. 1, 2, 3. So some people wait for the 1, 2, 3. So some people wait for the third candle to engulf, perhaps the first candle. So, but me, once I have this, I'm in, and my stop loss like below this itself. But just to be on the safer side, you can take this, and then 1:2 risk reward, or targeting this high. So if you look at 1:2 risk reward, that's your first target anyway. Now it depends on how you now use this here. The market again blunder down. Well, you are still within the region, no problem. You got here squeezing. So that's why I say their structure can be very funny. So till you have here, then this is a change of break of structure. This is a change of character, but internally here you can see some. Here, okay, none. There is none. So I think you only have it here, 1, and this one. So this one. So this is a change of character. This is your entry here. And this formed the engulfing candle, and this is the entry. You can see all said and done, you still form this one break, and this one change of character from here, and then return back here, your entry. So eventually traveled, oh, not even too well. I think they kept just doing, and if you look at it now, this is to tell you that there's a need for always taking some profit. But I have a culture, my DCA pattern of trading is what make me to have one initial position open and the stop loss below, and I'm good. So this is more disorganized, but yet you can still find beautiful trade. You have to just walk and see the one that suits you, because sometimes, so the same thing you do to the crash or the Painx&Gainx and all of that. So 1,002 gains. Now, one of the things that if I'm not seeing a trending one, I don't take it. So it's okay, 999. All right, so that's what it is. This is my Christmas gift for everyone trading Boom&Crash, Painx&Gainx. So watch it again and again, practice it. If you don't want to practice on your account first, you can open a demo, practice it, and understand the psychology before you go full blast. Thank you, and you have Merry Christmas 2025. 2026 shall be glorious and fantastic. Have a nice time.